The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is the beginning of the 2024 tax season, which those returns are due April the 15th, 2025, and we are here to make sure that you know everything you need to know. And there's lots of changes, so we're going to get busy with that. And, of course, I have my buddies in studio with me. I have Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday to you. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. Okay, and we also want to say we're excited that we're on Guff Radio, WGUF, in Naples, Marco Island, 98.9. So we're going to help all those people down in Florida to save money, as well as us being on 9:30 a.m. WBEN up here in Buffalo. So we're excited about that. We're going to be, for those people that are down in Florida that want to do the live phone calls like we do here. Unfortunately, that won't work. You got to go to our website at egtax.com, ask the tax lady, put your question in, and we can answer your questions that way. Right?
Yeah, sometimes you'll answer it in the middle of an airport, on your boat, a boat, wherever. You just ding,
Absolutely.
ding, 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 you know?
Right. Okay, and so we have some things that we want to talk about. We're starting the brand new tax year while getting ready to file the 2024 tax return. So there are things we're going to talk about that are coming in 2025, and there's some things we're going to talk about that we want to make sure that you know for 2024. And in the meantime, if you want to kind of start piling up on the phone lines here, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And I think the first thing I want to talk about is the stimulus money that millions of people are going to get from all the way back when there was COVID.
Hey, Esther, you and I were talking earlier. I just also want to really, at the top of the show, say our hearts and prayers go out to everybody in California for the devastation and the loss. And so I just want to put that out there. Just our prayers are with you guys, right?
Absolutely, and I was going to talk about that a little later, but
I'm sorry.
That's all right. I want to talk about casualty losses, and
that
so
works.
those poor people out there are really looking at casualty losses, as well as people in Florida with the hurricanes.
Yeah,
you know, basically you got the two most devastated states in the United States. One from hurricanes, which only lasts for a short period of time, and what's going on in California. And it's day after day after day. It's just unbelievable. But anyway, I was talking about the stimulus money that millions of people are going to get that didn't get when the 2021 stimulus payments came out when there was COVID. The IRS and the Treasury Department has realized that a lot of people, millions of people, never got that $1,400. And so if you are somebody that gets $1,400 in the mail, you should say, hallelujah, they corrected their error. However, if you never filed a return, you are entitled to that money, and you only have till April the 15th of 2025 to get the return filed. Even though you don't have to file, you need to file, or else they won't know who you are and they won't send you that stimulus money. Right, guys?
Right. Yep. So, yeah, if you filed, you're good. You'll get it automatically. If you didn't, you have to file to get it.
Right.
So,
by April the 15th of 2025.
correct.
Then there's this new thing that's coming down the pike for 2025, and it's called it's an elective deferral for people that made payments to their student loans. So this is really weird. This is something for employers and people making student loan payments. Chris, if you want to explain it?
Yeah, right now it's an optional program where you have your employees, if you're a business owner and you have employees, or if you're a worker out there, you should ask your employer about this, is if you're paying on your student loans, the amount of your payments count towards your elective deferral into your 401k. So even though you're not putting the money in your 401k, it counts as though you did, which means the employer would match that. So even if you're not contributing to your 401k, you're paying off your student loans. If your employer likes you and wants to do it, they can use those.
Well, that's what they said in the IRS article. This
Yeah.
helps you to retain employees. So let's say you paid $5,000 in student loan interest this year. You paid $5,000 in student loans this year. So, and your salary is $70,000. Then, and you made no contribution to your pension plan. That $5,000 that you made to payments for your student loan is as if you made a contribution to your pension plan at work. So if your employer were doing a 3% match, 3% on 70,000 would be $2,100. So the employer would look at that 5,000 that you paid and then say, okay, well, we're going to do a match on that $5,000 up to 3% or $2,100. So even though you didn't contribute, the employer does a match because it's an elective being treated as an elective deferral.
Right. And I think what they're doing this is because it's hard for young people who just got out of college to find a place to live, to pay off their student loans, to pay, because the high cost of even cars are super. So the government's like, well, they're not going to be able to save for their retirement, so let's try this to see if some employers will kick into it.
Right. So that's especially for, and if, of course, here's the thing, it's so buried in the law, they haven't even written the regs yet.
Right.
And so you want to make sure if your kids are paying student loans, that they go to their employer and say, oh, guess what the tax lady said this weekend.
Human Resources is going to be like, huh?
Right.
Call
Right.
Esther.
Yeah. And then the other thing is there's this super contribution you can make to your pension for the catch-up contribution. If you're 50 years or older, you can do a catch-up contribution on your pension. Well, now there is a super contribution you can make if you're between the ages of 60 and 63 of an additional $3,750. So you get the first catch-up contribution, and if you're between those golden years, 60 and 63, you can put an extra $3,750 away.
That's very smart. It costs.
And
a lot more.
obviously, pension plans are so important, right?
That's right.
All right.
Yep.
Anyway, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. I think that covers what I
You
wanted.
wanna go to
talk about
Ray
right
before
here.
the
Yeah,
break?
let's go to Ray. How are you, Ray?
Hello there. Boy, what a good way to start the show with the retro stimulus. I had heard about it, and I checked my return from a couple of years ago, and we did not get it. But my question is, we're married, filed jointly. We have two dependents. Is it $1,400 per person, $1,400 total per tax return? Well, I don't want to get greedy, but I don't want to be disappointed or maybe I want to be overjoyed.
So they should have mailed it to you during that time. Unless you didn't get it, then we would have captured it on your tax return. But did you get it in the mail around that time?
No, nothing. In fact, it's not even listed on the tax return itself.
Yeah, but
My son
it wouldn't be listed on your tax return if you received it in the mail.
No, we did not.
Was your income over $150,000?
I'll say yes, just for the sake of. I believe yes.
That's
but
why.
the
It was the
adjusted
cap.
gross income was less after deductions and after.
Yeah, but
everything else.
they went by your AGI. So if your
Okay.
AGI was over 150, it was too much money.
Okay.
But it is
Unfortunately.
$1,400. The full credit was $1,400.
Right, but if you did, maybe if your income was smaller and you didn't know to put it on your tax return,
Right.
the IRS is recalculating and they will send it to you. So you may
All right.
But
just
if
check
you
your
wanna
income.
but if you want, Ray, you can call us on Monday. We'll have you pull out your return, read the line, and we'll tell you.
All right,
if
thank you.
qualify.
But
All right.
in a great world, though, it would only be it's a maximum of $1,400, not
Per
$1,400
person.
per person.
It is per
Oh, it is
person.
Per person.
Oh, so in my case, it would have been $5,600 if I am
If
eligible
you
to
had
receive it.
4 people. Yep.
Right.
Oh, well, okay. I'm gonna dig.
All right.
Thank
good.
you.
Good.
Give
Thanks
us
for
a buzz.
calling. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text at 716-8030930. We're going to take a short break. We'll be back on the other side. Hey, to us, you are family. I'm Esther Gullius, the tax lady from EG Tax. All of our branch offices will open January 20th. The IRS is open for business on the 27th of January. If you want your return done before then, before our branch offices open up, you can always come to our corporate headquarters, which is at 1890 Colvin in Tonawanda, and we'll get it done ahead of time, but we can't really submit it till the 27th. So the IRS seems to push back a little more every year, right?
Yeah, but we've discovered that sometimes we can sneak in a few early, and
Right.
so
They will sneak them in.
I've
So-
done a few tax returns already, and everybody's been really happy, and they know what the
Okay,
answer is.
All right, so we have line 2 that's been holding. How can we help you?
Hi, Norma.
Oh, yeah. I didn't know who line 2 was.
I'm sorry, Norma. Forgive me. I'm Esther Gullius. How can I help you?
I have a question. I have a pension from, obviously, when I was working. I've been out of work on due to a disability for quite a few years, but I've never touched it. And I am 68, almost 69, so I can use it if I want. But my thought is that it gets 5% interest, and you'll always get 5% interest. It's guaranteed. However, I know I can do better with the market because I have, somebody who handles our other, interests, and they're definitely getting much better. Can I switch that pension somewhere else that I'm not going to get penalized horrifically?
All right.
by
Well,
the
first
tax
of all, if you do a trustee to trustee transfer, that's not going to be a taxable event anyway. You can take it from your pension to an IRA, and that will not cost you anything as long as you don't take any money out. So that's number one. Number 2, are you a married lady?
Yes.
And does your spouse also have income?
Well, he did until he's 72, and he just got laid off, believe it or not.
Okay, so are you and your husband living on Social Security?
Here we are now. We both lost.
Do you have any
income.
other
I
source of
lost-
income besides the Social Security and this pension that you aren't taking?
My husband has a pension, about $600 and some a month that he takes.
Okay, so about $7,000 a year, right?
Yep.
Right.
Okay, so if the only income that you have is that $7,000 pension and your Social Security, that means that you can actually start withdrawing from your pension tax-free.
Okay.
Because your standard deduction, because you're both over the age of 65, is very high. It's around $33,000. So you actually have quite a gap between your taxable income and your standard deduction. So you can actually start withdrawing money and put it in your higher investments. And if you stay below that threshold, you can do that and not pay any taxes.
Yeah, and Norma, I just want to chime in that you can move it, but there's a fee to move it. So what Esther's saying is really economically feasible and makes more sense.
right to take the money out of that pension
Right,
little by little.
utilize
so I
that.
don't go
So if
over
you
that.
want to give us a call, Norma, what we'll do is we'll take a look at what your taxable income is, and then we'll see how much gap you have between your taxable income and your standard deduction. And it might be like $15,000 that you can take out of your pension plan tax-free and then just roll it into your other investments and get the higher income, and it's already been taxed.
Oh, that's great, because with this loss of a major, I mean, we lost almost $6,000 a month
Oh,
Right.
Wow.
oh,
total.
oh.
So, going down to less than 5,000 between the two of us, and then his pension. It's really
Well, there's
taken a hit.
several
So
things that you can do, but one of the things I would take a look at, there are many seniors who are just waiting and waiting and waiting to take this money out and as a required minimum distribution until they're 73. But the truth is, if you just utilize the high standard deduction that you have, you can take money out tax-free right now.
Now, can I take mine out tax free and he takes?
Well,
his
what we
out
need to do is
tax-free?
take
I'm
a
worried
look at
about
all the
something
numbers.
Big happens,
Yeah.
We need to look at all the numbers, so give us a
Call
call.
Chris
We'd
on
be very
Monday.
happy to help you.
632-7886. Very smart of you to think like this,
Thank
though,
you.
Norma.
Right. I mean, and that's the
Thank
whole
you
thing.
ever so much.
You're very welcome, Norma. I mean, that's the whole thing. You want to take a look at your finances and plan.
Yep.
I mean, you can let it happen to you or you can make it happen.
Right.
And making it happen is usually a lot better than waiting for it to happen to you.
Yep.
Right?
Yes.
Okay, so the other thing you want to make sure that this being the first part of the year, if you have not opened a 401k plan, 403b plan, if you haven't put money into an IRA, if you're working, if you have high deductible health insurance and you haven't put money into the HSA, now's the time to get it done, right? You want to start off the year proactive.
Yep. You always taught me if you don't do it, it's just like opening up a window and letting throwing the money out the window.
Especially if you got a match from
Match.
your employer. It's absolutely throwing money out the window. Okay, we have some text here, right?
Yeah, we've got a phone call and a text. The text is, can you repeat that info about student loans and what should you tell your employer? I turned on the radio late. Thank you very much.
Okay, so buried in the law is a change so that if you're somebody who has a pension plan at work and your employer has a match, if you make payments to your student loans, then the amount that you paid in student loans is going to be used as if, for computation, as if you had made a contribution to your pension plan. Then your employer can do the match on money that didn't go into your pension plan, but rather went to pay student loans. Did I say that okay?
Yes, you did.
So it's quite a deal. So you would talk to HR and say, and the interesting thing is, what kind of proof do they need?
None.
They just have to say we did it.
Right.
They're taking your word for it too. So
That's because
it's
the regs aren't.
really an interesting thing. But here it is. So if you had made a $5,000 payment to student loans, and your income is $70,000 on your W-2, and the employer's doing a 3% match, that means that they would either do the $5,000 or the $2,100, whichever is less. So it'd be the $2,100, and so that would go into your pension plan based upon money that you paid for student loans.
Correct.
Yep.
Really,
And-
really unusual. I don't know who thought about that one. That one is quite an interesting
Right.
thing.
And there's no tax incentive for an employer.
Except that they're keeping their employees happy, like they said in the IRS publication.
Hopefully,
right?
they're keeping their right.
Right. Okay, we got Paul here on line one. Hey, Paul.
Hi, how are you?
I'm good.
Good. I want to say thank you for all your valuable information. I don't think you get enough kudos for that on the
Well,
air, at
thank
least.
you.
You're welcome. I had a fire at my house, a very big one. Lost most of my receipts on my rental property because I have 11 houses. And now I don't know what I'm going to do for my taxes. I don't know what the heck to do now.
I think you called the office the other day, right, Paul?
Yeah, I did.
I talked to you. Yeah, yeah. And I said to you, do you have credit card statements that you could get?
Yeah.
And you said to me, you do bank card, you do your bank. And so I said to go to your bank and get your statements from the bank, because usually you put it on a bank card. But
I mean, what kind of things
rental
are you,
property. It's rental
what kind of proof are you looking for? Is this rental property?
It is.
Or is this your personal
It's
residence?
rental properties.
No, rental.
Okay,
And
so
the thing is, I have paints and stuff I buy from Home Depot or in all the different places.
okay, but are you paying cash or do you put it on a charge?
Sometimes I pay cash, sometimes I charge, but most of the time I pay cash because I don't like cards anyway.
Well, if you are paying cash, number one, this is the first part of the year. I would change that procedure right now, because the burden of proof is going to be upon you to prove what you're putting on your tax return. A lot of it can be reconstructed because of credit cards, and if you paid anything with checks. But if you don't have proof, in the event of an audit, you would lose because you don't have any proof. And so, rule of thumb, whenever you are paying a bill that's going to be deductible, make sure that you, in the event of an audit, can prove what you put on that tax return. And the easiest way to do that is to put it on a charge card, because they'll send you a statement at the end of the year.
That's true. What are these people doing in like all these fires out in California and those hurricanes? They do the same problems I have?
Well, they're dealing with casualty losses. As a matter of fact, you might have. Are they going to tear down the structure?
I have to make a decision on that. I don't know yet.
Okay, because there may be something in your situation.
No, unfortunately, he's got to be in a natural disaster to claim the fire.
Not on
a presidential national disaster to claim it.
Not on a. What's the word?
We'll come back to Paul.
No, but we'll talk about. Hang on for a second. We're going to break for news, and I'm going to talk to Chris off air, and we'll be back on the other side with your questions and comments.
You can't.
Hi, this is Esther Gullius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. Okay, so I was trying to think about the word involuntary conversion.
Paul's back on.
Paul, did you say that it was rental property that burned down, right?
No.
No, it's my personal residence.
Okay, so you can do an involuntary conversion in the event of a fire on a rental, but not on a personal. So what you have, didn't you have insurance?
Yeah, I did.
So are you really, aren't you going to be made whole by your insurance company?
Well, there's a difference in property values and what the insurance is, and it's a little bit hazy yet.
Okay, so in the event that you are not made whole on your personal residence and you lost money in the fire, that would be a casualty loss only if it's a federally declared disaster area, like what's happening in California or what happened in Florida. So unfortunately, you really have to put all your numbers together and see how everything turned out. But casualty losses are only deductible on a federally declared disaster area. Involuntary conversions would be on rental losses, and you didn't suffer that.
No, you're right.
So the moral of the story is to start this year using credit cards to track your rental expenses.
Absolutely.
Yeah.
Okay,
yeah.
but you will, the money that you're getting out of the insurance is not going to be taxable anyway. So that's and you can rebuild.
Okay. Well, thank you for that.
All right, you're very welcome. I'm Esther Gullius, the tax lady from EG Tax. What else do we have here, Tiff?
There's Mark on line 2.
Okay, hey, Mark.
Hey, Esther. I'm sure you're aware of the New York State credit for sales tax overages that New York State is supposed to give to the citizens here. Have you heard any more about that?
No.
Chris, you're quite an expert.
No,
on this.
they have not come out with any details yet, and that's not going to be until like September, October of this year.
This year. Right.
Didn't you? It's-
I didn't hear any
So
more
stay
about
tuned, because as soon as we know, you'll know.
it. So that's what bothered me. Didn't hear you say it.
Yeah, I know I hate to get political, but I was talking to Chris about it, I think on Thursday, and he said, or somebody, and they said, yeah, Kathy Hochul, it's getting close to the election, and so we got to do something for the voters, right?
Yeah, the closer we get.
Yep. Got to do something for the voters.
Trying to get a good image.
Yeah.
I don't know. All right, but thank you very much.
Well,
All right, thanks for
Thanks,
listening.
Mark.
As soon as we
I'm
find
Esther
out,
Gleason,
we'll let
the
you
tax
know.
lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Other things that you should look at starting the year, like for instance, was Paul, right? He's a cash people. Some people love to pay cash. Well, if you love to pay cash, in the event of an audit, you're going to be very sad because you have to prove everything that you put on your tax return. So especially in his situation with rental property where he's incurring expenses, maybe he can go back to some of his contractors and ask them how much he paid and ask for receipts. That'll help. But it becomes really a pain in the neck. Whereas if he just paid by credit card, they would send him a statement at the end of the year, and he'd have the proof, or at least part of the proof.
Yep. And I was thinking, like, if he put a hot water tank in and they bought it in Home Depot, he could go and get another copy of the receipts and things like that. But it's going to be a lot of work.
All right. So looking at this year, moving forward, if you're somebody that is a senior and you have a personal residence, you might want, and you're strapped financially, think about a reverse mortgage.
Yep.
I mean, that way you get tax-free money out of your home to help augment your expenses that you might be incurring so that you don't have to move out of your home. So that's something that you might want to look at this year. And a reverse mortgage, you can just Google it or you can call us. We'll be very happy to help you to look at the banks that are doing reverse mortgages. The great thing about a reverse mortgage is that it gets you tax-free money, and and even if you have an existing mortgage, they'll pay off that mortgage. And if you have equity in your house, they'll set you up on a payment plan, give you a checkbook, so you have the extra money to live on.
Yeah, it was designed, it was a presidential design product to keep seniors in their home, which is a wonderful thing.
And the other thing is, we're, again, first week in January, if you're somebody that has been dealing with the IRS, state of New York, on an outstanding tax obligation and you can't pay it, we have an offer and compromise that we can do for you, right, Tiff?
Yeah, it's a great opportunity. It's, they also call it a Fresh Start initiative. So if you owe lots of money to the IRS for whatever reason it is, if you are in a situation where it's doubt to their collectability, we can fill out the paperwork. Like everything else, it's lots of paperwork. And so I can sit down and help you fill out the paperwork. There's one for the federal and the state, and it's really paying pennies on the dollar. So if you owe, for instance, $80,000, maybe you just have to pay $400. It's a lot like playing tennis. You offer them something, they'll come back and counter and back and forth. But again, I can't stress it's doubt to collectability. And so if you have assets such as a home, they might say, maybe you can get a pension. As Chris said, you could get a home equity. And so it's really, if you're in a situation where they couldn't collect the money, and the Fresh Start initiative is what it is. It's a fresh start.
Right.
And
So that's, again, there are people that keep piling up debt year after year after year with the IRS and state of New York. Eventually, it really can be a problem. But after 10 years, what happens?
After 10 years, the debt is generally goes away with the IRS.
Right.
Yep.
All right.
It falls off.
All right. I want to talk about things that you should really watch out for. And just like that gentleman at the beginning of the show, he said he didn't apply for the $1,400 per person stimulus money. Maybe it's because of his income. We don't know right now. But there are many people that are do-it-yourselfers that don't know about some of the things in the tax law. I wanted to cover that too. For instance, the child tax credit. What is that? How much money is it?
Well, the child tax credit starts at $2,000. And for 2024, it's up to a $1,700 refundable credit that if you don't have any tax, so the child tax credit doesn't help, the $1,700 turns into a refundable credit, so then you get $1,700 for your child.
Right. Now, the thing is, many times in a situation where mommy and daddy aren't living together anymore and the non-custodial parent is claiming the child, many times there's a kind of a fight between the two of them, who's going to claim it. If that's your situation, I would suggest that you sit down with your accountant and see who makes out better. Because if the family does better by him claiming it, for instance, the child tax credit, you still, if the child lives in your home and you're working, could qualify for the earned income credit, because that's a different kind of credit, correct?
Correct.
So there's the child tax credit for children under the age of 17. Then there is the earned income credit for parents that are working, that have moderate income, lower to moderate income, where they actually pay you money because the kid lives in your home. So even though daddy's claiming the child who doesn't live with him, if the child lives with mommy, then she could get the earned income credit, he gets the child tax credit. And that can work out really well for a family.
Yes. Oh, very lucrative if they fall in the right spot.
But here's the thing. If you don't understand the tax law, you can mess up.
Exactly.
And that's the point. Now, in the event that you're finding out something today you didn't know about, and you haven't done this correctly, you can go back and amend those returns up to the last 3 years.
Yes.
Right?
And that's
Okay.
why 21 people can still get their stimulus money, because that year is still opened up until April 15th.
Okay, let's go to, should we do a text or a phone call?
Phone call.
Okay, phone call. And this would be Ed, right?
Yep.
Hey, Ed, how can we help you?
Oh, hi. Thanks for taking my call. Yeah, I had a question here because this is something new for me. I've been investing in some corporate bonds, and I've had some instances here where, where I pay interest, okay, on the bond, but I believe that when I get, my, 1099, they're going to report all the interest that was paid to me, okay? However, I also had to pay interest owed on the bond. So do I need to somehow reduce my cost basis, and how would that work?
Okay, so basically what you're going to do is you're going to adjust the income you received by the income that you paid on the bonds, because you bought them in the middle of the term, correct?
Right.
So you just...
Where would I do that?
On the Schedule B, you're going to do that.
On Schedule B?
Right, because that's where interest is reported.
The
Okay.
interest income, yes.
The interest income is then going to be reduced by any amount that you had to repay. So let's say you got $10,000, but you had to pay $3 because it was purchased in the middle of the term. So you're going to report $7.
Okay, so
It's taxable.
is there a special place for it over there in Schedule B? I can't remember what that looks like.
There is on our program where you do the computation.
Okay, is there anything on TurboTax, do you know?
I never looked at a TurboTax program. I
Okay.
wouldn't know. But if you want to call tomorrow at the office, what we can do is figure out if there's a place on TurboTax, but I have to believe there is.
Okay, yeah. Like you said, I'm aware of it. I talked to somebody about it, a friend of mine who, I know about it, and he said that, you got to deduct it, but I just have
it'll be done on the Schedule B. You might want to do a worksheet to show how the computation happened, but the income that you received on the bond, they're going to report the whole thing to you. You adjust it by the amount that you paid. You paid for the bond premium in between.
Yeah, that sounds good. It's too bad that on your 1099 they don't really list it as an adjustment.
Right, and that's what's going to get reported to the IRS is the gross amount.
Exactly. Yeah. Okay. Well, okay. That's really
give us
good.
a
I'm
jingle
glad,
because
you were able to confirm that for me.
Because
and
we
how I
have
would do it.
on our program we have that ability to do that, and it shows up on the Schedule B as an adjustment. So, give us a call. Maybe we can help you.
Okay.
All right. Thank
super.
you.
Thank you very much.
You're very welcome. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and you can text us at 716-8030930. We're going to take a short break. We'll be back on the other side.
The bills make me wanna kick your heels up and throw your hands up and throw your hands
Well,
back and
tomorrow's a Sunday.
And we know where Esther will be.
I'll be hiding.
I know where
But
Chris
it's
will
great
be.
to listen to other people. I mean, like the financial guys, they were saying, oh, they get so nervous. Well, I'm not the only crazy person, right?
No.
Right. I mean, yeah. So I pray that the Bills do good. What do you think, Chris?
I believe in my heart they're going to do good, but don't want to get fooled by your heart. So I'm keeping my sights.
Are you going to be in the? Are you going to go?
I will be in the stadium cheering with all the 75,000 other Bills Mafia members.
That's a benefit to have the home field advantage.
Yes.
You know? Yeah.
That's true with all the mafias, right?
Yes. Yeah, I just saw a text from my daughters. I believe the Broncos are in town. They just saw 10 buses with police escorts.
Oh, sure, that's true.
So they
All
must
right,
be
I'm
here.
Esther-
So go
I'm
Bills.
Esther Gilius, the
if
tax
they're
lady
listening.
from EG Tax, 8030930, 8030930, star 930 on a cell phone. Okay, we have lots of stuff here. What should we do next?
The text. My grandson, Esther, has paid in his student loans in 2024 and 2025, and the employer does match. But how would this new law benefit the employer? Does it at all? They get to keep
the
their
employer
staff.
just pays extra money.
But they say in the law it's because you want to retain your staff.
Well,
right?
it'll be deductible on the employer's tax
Right,
return.
the money
That's it.
they match will be a deduction, but that's it. I mean, it's going to cost them more money than
Right.
what the benefit hopefully will be the person stays.
Yeah, and as Chris and Esther said, the guidelines for this law haven't been written because, as you said, Esther, it's so buried. It's still to be determined. So many things regarding it, right?
Right. Absolutely.
Yeah.
Absolutely. So, but it's wonderful for. Well, first of all, if somebody, I don't think the employers even know about this yet. So if somebody goes to their payroll department and say, "Gee, there's this in the law," and you can Google it, by the way. And it talks about it on at the internet, so that they will know that whatever the employee puts in to pay the student loan will go towards their elective deferral. Now, if the employee already puts in the maximum into their elective deferral, then it's not going to be a benefit because the employer's already doing the match.
Yeah.
Right?
Yeah.
It really helps in a situation where the kid is making student loan payments and they can't afford to put money into their pension plan. In that situation, it would be something where the employer matches the amount they put into their student loans.
Yep, understood. The next text is really easy. I can't always catch your shows, but The radio, since I went to your website, the last show I see is since November. How do you update this? Well, the truth is we have a new website. And so
the gentleman's coming in Tuesday to teach us how to add the stuff to it. So come hopefully Tuesday night, all the radio shows will be listed there once again.
Good.
Okay.
That's good. All right, what else we got?
Text. My 89-year-old mother's annuity contract matures January 30th, 2025. She must take a full distribution when her contract matures. She has the following options. Annuity benefit. This is number 1. She can receive the value of her annuity as a periodic income payment under an option guaranteed in the contract or another form of income annuity. Number 2, receive lump sum. She may elect to surrender the contract and receive a lump sum. We need tax advice ASAP. How can she have the least tax consequences? Please help and advise.
Okay, so first of all, whenever you have an annuity contract that you funded it with after-tax dollars, right?
Correct.
That means you have a basis in the annuity, and the only thing that's going to be taxable would be the appreciation in the annuity.
Yes.
So let's say that she put in $100,000, and when it matures, it's $150,000. If she takes the whole enchilada, then only $50,000 of it's going to be taxable.
Mm-hmm.
If she spreads it out, then that same percentage is going to be taxable throughout the payments that she receives. So the only way to figure it out is to call us so we can see what her tax situation is. But let's say that she put in 100 and it grew to 120, then 20,000 is going to be the amount that would be taxable. And if she is a senior and that was her only source of income except for Social Security, with her standard deduction, it might not be that bad for her to take the whole thing. It all depends on how the numbers work out.
Yeah, I always explain to my client with an annuity, it's the gain that's taxable. And I know you already explained this, but sometimes two people saying it. So for instance, if you put in $200,000 and now it's worth $270, it's the $70,000 that's taxable. So
Correct.
correct.
Right. All right,
Yeah.
what else we got?
That's it.
That's it.
Yeah.
Okay.
And so I would welcome this person also to call the office on Monday if they need further guidance on it, right? 632-7886. But with an annuity, it's the taxable situation is much more difficult to explain.
And if people are listening in Florida under WGUF, WGUF, get the area code is 716. So call 716-632-7886 during the week, and we'd love to help you.
Yep.
Right. So getting back to our guy with the accrued interest that he wants to make that adjustment, when you're getting interest income, part of it might be like, let's say that you have $10,000 in interest from a bank account that is actually supposed to be for yourself and your sister. You can make a nominee distribution back to your sister showing the Internal Revenue Service, because you're issuing her a 1099, that this was a nominee distribution. You can adjust for that too. So there's nominee distributions, accrued interest distributions, OID adjustments, which kind of sounds like what he's got, and ABP adjustments. So all of those can adjust interest, but you want to make sure that you have that spelled out on the Schedule B, because they're going to probably question you if you don't have some kind of an adjustment on there. And I don't know TurboTax, so.
Right.
Right. And then if you do have margin interest, that's different.
Right.
That's
margin interest is a deduction.
That's
It
right.
is on the Schedule A.
So it all depends on what you have. Right?
Yeah.
But we're always happy to help anybody if you have a question during the week. You don't have to wait for the radio show on Ask the Tax Lady. You can call us. We have real people that answer the phone and talk to you.
Yeah. I also want to say about this annuity question, I have a lot of clients that unfortunately people have passed away and they inherit an annuity. And so, when they get the 1099-R and they bring it in and they're paying tax on it, don't you find out that it's sometimes much more cumbersome because of the inherited property of
Well,
it.
they have to pay tax on the growth just like
On the
the
growth.
individual.
Right,
So
right.
it comes down to tax planning again. Do you take it now or do you take it over time? What are your options and how much is the growth? And so it's a
always doing a math problem.
Right, but
It's always doing a math problem.
Yeah, I find out if people don't know the tax law and the taxability, it says it doesn't list it, they'll completely tax it at 100%. You know what I mean? So you just
Well, but the annuity company would show the
Should.
gross distribution in box one,
Mhm.
but hopefully they would show the taxable amount.
Yeah, sometimes then
not
it's
always.
if
and
they
then
don't, you
sometimes
got to
it says
call them.
Taxable amount is not determined.
Right.
So you have to really look at those 1099-R forms.
Yep, that's what I'm saying. Yep, because people don't. It's really, really difficult.
All right. And the other thing is, when you're taking a look, when you're doing your taxes, remember that Chris was talking about, the child tax credit is $2,000, and the refundable portion $1,700. But you have to have something to get that $1,700 as a refundable portion, don't you, Chris?
A child?
Okay. How about wages?
Wages, earned income.
Okay, that's where I was shooting. In other words, again, with that splitting of children, if the non-custodial parent has that child, it takes the $2,000 for the child, but has no wages, that is a horse of different color, right?
Right, because
they wouldn't get the $1,700.
Right, it can't turn into a refundable. The refundable happens when you pay into Social Security.
Right. So there's all these caveats where if you do it wrong, and it's mathematically correct, the IRS is not going to call you up and say, gee, shouldn't George have taken this rather than you? Because you would do better off because you have wages and he doesn't. I mean, all of these things, it's all dollars in your pocket. And that's part of what we are all about. We want to make sure that you get the best tax refund, lowest tax liability, right?
Most definitely.
All right. And we have a new website like Chris was talking about, and it's really pretty.
It is very easy to use, very informative.
And you can make appointments online.
Right. You can you pick your office, you select.
And you can ask me a tax question.
For sure.
That's right.
Ask the tax lady. So we and we'd love to hear what you think about it. I mean, if you think that we need to do an enhancement, right now we're working with our web designer, so your input is appreciated. And so, anyway, until next week, I'm Esther Gullius, the tax lady from EG Tax. You can go to our website at egtax.com with Tiffany Fabian, Christopher Fabian. Have a great week. Go Bills.
Go Bills. Amen.
Thanks for listening.